All right, welcome back, Focus Learners. Let's jump right into this explainer. So it's May 2026, and the broader markets are currently navigating some pretty extreme volatility. We've got geopolitical instability in the Middle East, surging oil prices, and everyone is intensely scrutinizing the Fed's next moves on interest rates. But amidst all of this macroeconomic noise, there is one financial translation we really need to make sense of above all else. We are literally witnessing a massive structural shift happening right before our eyes with the world's most heavily debated stock, Tesla. So, is Tesla still just a car company? I mean, it's a totally provocative question, right? Now, if you look at their Q1 deliveries, they still pushed out over 358,000 units. But here's the thing. If you're only looking at the metal boxes with wheels rolling out of their factories, you're completely missing the forest for the trees. The real story happening today goes so far beyond traditional auto manufacturing, and it fundamentally changes exactly how we need to value this entire business. Okay, let's dive into our agenda for this analysis. We're going to cover the AI transformation, follow the cash flow, check out catalysts and recent news, break down the robotics valuation, chart the stock, and wrap up with the investment strategy. Moving to Section 1, the AI transformation, we're taking a look at the pivot from auto manufacturing. Our source material actually summarizes this macro thesis perfectly. It says, Tesla is undergoing a fundamental physical AI transformation, executing a controlled transformation toward high-value AI software and robotics. Now, I really want you to focus on that exact phrase, controlled transformation, because the era of relying solely on 50% year-over-year vehicle delivery growth, that's setting. Instead, Tesla is actively rewriting its DNA to become the absolute dominant player in the physical AI space. Let's move to Section 2, following the cash flow. We'll do a deep dive into the Q1 2026 earnings to see what the money is telling us. Now, what's really interesting here is the sheer scale of the cash being generated. Operating cash flow didn't just grow, it surged an unbelievable 82.4% year over year. We're talking a jump from $2.16 billion up to $3.94 billion. And this proves that despite some slight revenue misses because of inventory buildups, Tesla's core business remains an absolute cash engine. Which brings us to free cash flow, or FCF. Basically, this is the cash a company generates after accounting for outflows to support operations and maintain its capital assets. In Q1, Tesla posted a positive free cash flow of $1.44 billion. So why does this matter to you? Well, maintaining this level of positive cash flow while aggressively expanding separates them completely from the pack of struggling EV startups that are out there bleeding cash just to keep the lights on. And they are going to need every single penny of that cash purely because of this absolutely massive number, $25 billion. Management aggressively updated their 2026 forward guidance for capital spending, hiking it up from an already staggering $20 billion. So this $25 billion represents their Capex, or capital expenditure, which are the funds used by a company to acquire, upgrade, and maintain physical assets. But here's the kicker. This $25 billion isn't going into traditional car designs. Nope. It is aggressively funding massive AI data centers and training infrastructure. It's expanding Gigafactory, Texas, and critically, it's building out production lines for their Optimus robots. They are willingly taking short-term hits to aggressively secure future AI dominance. All right, Section 3, Catalysts and Recent News. Let's look at the May 48-hour news cycle. This brilliantly illustrates just how insanely fast things are moving right now. In just the first few days of May, we saw the official launch of FSD Supervised in the Netherlands, complete with a $99 a month subscription model. They're retiring that old one-time purchase to lock in recurring software revenue, which is huge. We also learned they booked $573 million in revenue just by selling hardware to Elon Musk's other companies like SpaceX and XAI. Throw in a minor, easily fixable battery contactor recall for the Model 3 and Y, and a massive spring software update integrating the Grok AI voice assistant, and you literally have a flurry of short-term catalysts impacting the stock's fundamentals all at once. Moving to Section 4, the robotics valuation, and how we are pricing in the future. Right now, Tesla trades at an extreme 348 PE ratio, and that multiple is heavily driven by the leap between these two concepts, FSD supervised, where the driver must remain totally attentive, versus FSD unsupervised, where the vehicle assumes full legal and fiscal responsibility. Crossing this exact technical boundary is exactly what unlocks the value of the Cybercabs, those pedalless, steering wheelless robotaxis that are literally running test routes in Dallas and Houston today, aiming for mass production by late 2026. But honestly, the most disruptive tech in their pipeline, is Optimus, their humanoid robot designed to perform tasks traditionally done by humans. In what is just a mind-blowing operational pivot, Tesla is actively dismantling the legacy Model S and Model X production lines at their Fremont factory. Why? To clear space for a massive 1 million unit capacity production line dedicated entirely to the first generation of Optimus robots. Which brings us perfectly to the S-curve production ramp. Think of this as a visual representation of how disruptive products scale. They start really slow, then violently accelerate upward before leveling off. Musk is targeting an aggressive S-curve ramp for the upcoming V3 Optimus. With the prototype due mid-2026 and factory integration starting this summer, the goal is to hit consumer sales at a $20,000 to $30,000 price point by late 2027. It's quite literally a bid to replace human labor. Section 5. Charting the stock. Let's look at the technical analysis and momentum. Shifting gears from those macro fundamentals over to the technicals, we have to talk about a break of structure, or BOS. This happens when a price successfully breaks through a previous high or low, signaling a continuation of the trend. In late April, based on that early May price of $390.82, Tesla broke upward through its descending channel right above the $380 mark. For technical traders, this was a massive BOS signal. It physically mapped the market sentiment, completely shifting away from EV demand worries and straight back into physical AI hype. To support this, we look at the Relative Strength Index, or RSI. It measures momentum on a scale of 0 to 100. Right now, the RSI sits at a cool 41. That basically means the stock is completely neutral. It's neither overbought nor oversold. It's got plenty of room to run, especially with the 200-day moving average holding as a very strong bedrock of support down at $363. Unsurprisingly, the options market is heavily betting on a run, with millions of call contracts stacking up at the $420 strike price. Finally, Section 6, the investment strategy. Let's talk actionable targets and risk management. Let's see how the experts are tying all this data into their valuation models. They've broken it down into 3 core scenarios. The bull case targets $600, driven by successful Robotaxi expansion into 30-plus cities and Optimus hitting its mass production targets. The base case sits at $415 to $430, relying on steady vehicle deliveries and FSD subscriptions crossing 12 million. And finally, the bear case warns of a drop to $320 to $334, which would trigger if that massive $25 billion Capex burns too much cash without yielding AI results, alongside intensifying EV price wars with competitors like BYD. So the absolutely crucial point here is how you manage the risk of this incredibly high beta stock. The experts strictly advise limiting Tesla to a maximum of 10% of your overall portfolio. From there, the mechanics are pretty straightforward. Step 1. Buy by laddering into the $374 to $378 support base in fractions, rather than doing it all at once. Step 2, hold your position confidently as long as the price remains above that $363 200-day moving average. Step 3, sell and take a 30% profit off the table when the price hits that historical and psychological resistance level at $420. Which leaves us with the ultimate question to ponder as we wrap up this explainer. As you look at your portfolio and try to contextualize this incredible controlled transformation, you really have to ask yourself, are you valuing Tesla for the cars it makes today or the robots it will fundamentally build tomorrow? Because the answer to that question dictates absolutely everything about how you play this stock moving forward. Thanks for joining me for this deep dive, focused learners. Stay curious, and I'll see you in the next explainer.